Hello everyone, welcome back to our channel. For years, there has been speculation and debate around the Iraqi dinar and what an ideal exchange rate would be as the country works to rebuild its economy. Recently, currency guru Pimpy from the Newshound Guru website weighed in on this very question. Let's take a closer look at his analysis and perspective. For context, the Iraqi dinar is currently pegged to the US dollar at around 1,190 dinars to $1. This peg has been in place since the 1980s as a way to provide stability to the Iraqi currency. However, many believe this rate significantly undervalues the dinar compared to its realistic market value. When asked what he felt would be the ideal exchange rate, Pimpy suggested a rate of 1 dinar to $1, removing the peg entirely. His reasoning is that this 1-to-1 rate would strike the right balance, providing more purchasing power for imports into Iraq, while still keeping Iraqi exports competitive on global markets. Let's break down the potential impacts. A stronger 1-to-1 valued dinar would make imported goods and services significantly cheaper for Iraqi consumers and businesses. This could stimulate more economic activity and investment within Iraq by making key imports like machinery, raw materials, technology and expertise more accessible and affordable. At the current 1,190 to 1 rate, $1 million only buys around 838,000 dinars. But at a 1-to-1 rate, that $1 million could purchase the full 1 million dinars, unlocking almost 20% more purchasing power. Over time, this could be hugely impactful for economic development within Iraq. However, a stronger dinar at 1-to-1 with the USD could make Iraqi exports comparatively more expensive on global markets. Iraq's key exports like oil, dates, gold and manufactured goods may become pricier for international buyers. This could negatively impact exporters' competitiveness and profit margins in the short term. However, Pimpy's view is that the improved purchasing power for investment into Iraq's production capabilities could eventually make exports more competitive through improved efficiency and quality over the long run. Ultimately, Pimpy argues the ideal exchange rate needs to strike a balance, making imports more accessible to drive economic growth and investment, while keeping a level of export competitiveness, especially for oil, which remains Iraq's economic lifeline. According to his analysis, a 1-to-1 dinar to USD rate hits that sweet spot where Iraq can leverage the increased investment potential from more affordable imports, while still maintaining reasonable export profit margins. Over time, that increased investment could then boost overall economic productivity and competitiveness. However, any shift towards a new exchange rate would be highly complex, with potential impacts on inflation, the state budget, which is based on projected oil revenues, international debt obligations, and more. Maintaining confidence in the currency's value and achieving economic and political stability would also be critical prerequisites and challenges. Coordination with bodies like the Central Bank of Iraq, the IMF, the World Bank and Iraq's international creditors would be essential to properly manage the transition. While the 1-to-1 Iraqi dinar to USD rate is just one expert's opinion, it does represent a balanced approach that considers both Iraq's import and export needs as the economy works to rebuild and grow after decades of instability. Executing such a transition would be highly complex and has to be done gradually and with great care, but if achieved successfully, it could unlock significant economic potential within Iraq and put the dinar back on a path to becoming a strong, realistic reflection of the country's vast resources and potential. Whether you agree with Pimpy's specific 1-to-1 target or not, the broader discussion around revisiting the dinar's exchange rate is definitely an important conversation to have as Iraq maps out its economic future.